Welcome to the deep dive. Okay, so it's 2025 now, and plenty going on today, of course. But we're doing something different. We're actually jumping back, way back 64 years.
64 years, wow.
Yeah, to 1961. That's when Warren Buffett's 1960 shareholder letter actually came out. Think of it like a time capsule.
Yeah, definitely. Full of investing wisdom that honestly still feels really relevant.
Totally. It's amazing how much you can still learn from it today for how you think about markets.
And what's really cool is you're seeing these like foundational ideas of value investing as they were actually forming from the guy,
Before he was the guy, almost.
Exactly. This isn't looking back with hindsight. It's his thinking right then and there.
Okay, so let's get into it. Our mission, really, with this deep dive into the 1960 letter, is to pull out the core of Buffett's approach back then.
Right.
Now, setting the scene, 1959 looked like a great year for the market, didn't it? Dow Jones Industrial Average soared 16.4%. Huge. But here's what Buffett pointed out, and this is key. Fewer than 10% of investment companies actually match that or beat it.
Mm-hmm. Only 10%.
And interestingly, utilities, railroads, their averages actually went down.
So he wasn't just looking at that top line down number.
No, exactly. He was already thinking about relative performance. How are people actually doing compared to the market? And digging into different sectors, too.
Yeah, seeing the nuances.
The 1960 hits, and, well, the whole picture flips. Complete 180.
Right.
The industrial average drops 9.3%. Even if you count dividends, still a 6.3% loss.
Ouch.
But, and this is where it gets really interesting, Buffett estimated something like 90% of investment companies beat the industrial average that year.
90%, so the opposite of 59.
Completely. And on the NYSE, more stocks lost value than gained. It's this, dramatic shift that really tells you something important about his mindset.
Yeah, that contrast is stark, isn't it?
Yeah.
A booming market where most pros underperform, then a down market where almost everyone outperforms the index.
Yeah.
It really highlights his focus on protecting capital when things get tough.
That's it.
It's not just about grabbing gains, it's about losing less.
Precisely. Which brings us right to Buffett's main goal for his partnership funds. He put it very plainly. Primary aim. Long-term performance better than the industrial average, period.
And his reasoning was?
His reasoning was, look, over time, the average pretty much reflects how the leading investment firms do. So for his partnerships to be worth your while, they had to do better than that benchmark.
He's setting a high bar there.
Yeah.
Not just aiming for profit, but demonstrably better profit than the pros overall.
Definitely. And he was really specific about when he thought that outperformance would happen. He didn't expect to beat the market every single year.
No.
No. He actually predicted their best results, relatively speaking, would come in flat or declining markets.
Yeah.
When markets were rocketing up, he thought maybe they'd be average, maybe even lag a bit. What does that tell you?
It tells me risk management was front and center.
Yeah.
He was willing to maybe miss some upside froth
Right.
to make sure he protected capital and did better when things went south. It's a long game, not trying to get rich overnight.
He had that great analogy, too. He said, look, if the market drops 30% and we only drop 15%, that's way better, in his view, than if both the market and us gain 20%. It's about that asymmetry.
Exactly. Avoiding the big hits. That compounds so much better over the long haul than catching every single upswing. It's like filling a leaky bucket. You got to plug the holes first.
Yeah, good way to put it. Then he uses this golf analogy, beating par. He says getting a 4 on a par 3 isn't as good as getting a 5 on a par 5.
Okay, interesting parallel.
And it's unrealistic to think you won't face both kinds of holes, both kinds of markets. You can't ace every shot, but being consistently good across different conditions, that's the goal.
That makes sense. It simplifies it, right? Market
Yeah.
conditions change.
Yeah.
Some years are easier, some harder, but it's the long-term score that matters.
So, okay, that's the philosophy. How did they actually do in 1960?
The big reveal.
Yeah, well, the 7 partnerships that ran the whole year, they managed a pretty remarkable 22.8% gain.
Wow. And the market.
Remember, the industrial average lost 6.3%. So, yeah, a massive outperformance in a down year.
And that's exactly the kind of market where he expected to do well. So it kind of validates the whole approach, doesn't it?
It really does. Talking about it is one thing, delivering it is another. And if you look cumulatively, 1957 through 1960, the numbers are even stronger. Partnerships compounded at 140.6%, the Dow, just 42.6%.
Huge difference.
Massive. Now, Buffett himself, he immediately adds a caution. 4 years isn't that long. Don't draw final conclusions.
Typical Buffett humility and that long-term focus again.
Right. He's not spiking the football on a short-term win.
Yeah.
But he did say, look, the evidence seems to support the idea. Results are comparatively better when the market is flat or down, which suggests, he thought, maybe their portfolio was a bit more conservative.
Okay.
But maybe invested in less conventional stuff. Not your standard blue chip holdings. Makes you wonder what he was buying.
Yeah, it suggests he was willing to look, off the beaten path, find value where others weren't looking. That's classic value investing.
Now, he also mentions there were several different partnerships running at the time.
Right, not just one big fund yet.
Exactly. And while none consistently did way better or worse than others, there were some small differences. So his long-term goal, mainly for efficiency and to cut admin costs, was to merge them all.
Makes sense.
But, and this is telling, he said it would only happen with unanimous consent. Every single partner had to agree.
Wow. That says a lot about respecting his investors.
Yeah.
Fairness, transparency, not forcing anything.
Definitely. He also talked about adding money mid-year, basically because changing partnership agreements was complicated.
Especially with multiple families involved, I bet.
Right. Generally, new money only came in at year-end, but he made an exception. You could make advance payments. And he'd pay 6% interest on that money until December 31st. Then it officially joined the partnership capital.
So a bit of flexibility for people who wanted to add more without a huge administrative hassle.
Exactly. Then the letter takes this really fascinating deep dive into one specific investment, Sanborn Map Company.
Ah, the famous one.
Yeah. He reveals this one stock was, get this, 35% of their total net assets.
35%. That is not diversification as most people know it.
Not at all. And he says their involvement basically wrapped up in 1960.
That kind of concentration, it really shows his willingness to go big when he found something he truly believed was undervalued.
And the Sanborn story itself is just wild. For like 75 years, they basically were the source for super detailed maps of almost every U.S. city.
Right, these weren't just road maps.
No way. Huge, heavy volumes showing every single building, construction materials, who occupied it, fire hydrants, everything. Annually updated by pasting in little slips of paper.
Incredible detail and essential for fire insurance companies, right? For assessing risk.
Totally invaluable. It was this critical, specialized information, huge barriers to entry.
A real niche monopoly, almost.
Pretty much.
Huh.
Consistently profitable for decades, didn't really feel recessions, didn't even need a sales force.
Wow.
And get this, early on, the insurance industry itself was apparently worried Sanborn was making too much profit. So they put some of their own top execs on Sanborn's board to keep an eye on things.
That's interesting. Suggests the power Sanborn had, but also maybe sets up potential conflicts later on.
Good point. Because then, in the 50s, things started to change. This new underwriting method, carding, starts catching on.
Right, a competitor emerges.
And it starts eating into Sanborn's map business.
Yeah.
Even though the economy was growing overall, Sanborn's profits from maps just plummeted. From over $500,000 a year after tax in the late 30s to under $100,000 by the late 50s. The core business was clearly fading.
Shows how even dominant businesses can get disrupted, doesn't it? Carding was maybe less detailed, but more efficient for something.
Exactly. But here's the twist. Because the map business didn't need much capital reinvested, Sanborn had started, way back in the 30s, just quietly building an investment portfolio with the profits.
Ah, the hidden asset.
Totally. And over time, this thing grew to about $2.5 million, half bonds, half stocks, roughly. So while the map business was tanking,
Their investments were growing.
significantly.
Classic situation. The real value isn't in the main business anymore, but in these assets the market's ignoring.
And the valuation gap was just mind-blowing. Check this. 1938, Dow is maybe 120. Sanborn stock, $110 a share.
Okay, priced reasonably back then.
Now, 1958, Dow's around $550. Sanborn stock, only $45.
It went down while the market soared.
Went down, but over that same time, the value of their investment portfolio per share went from $20 up to $65.
So the investments alone were worth $65 a share, but the stock was trading at $45.
Exactly. By 1958, the market was basically valuing the actual map-making business at negative $20 per share.
Wow. That is the kind of disconnect that screams opportunity to a value investor.
You bet. Buffett points out, look, Sanborn still had incredibly valuable data, cost tens of millions to replicate. Even with carding, companies using maps still wrote like $500 million in fire premiums a year.
So the data was still useful.
Yeah, but Sanborn just hadn't changed how they sold or packaged it, so earnings stayed flat. You have to wonder why they didn't adapt.
Failure to innovate, right. Sitting on a gold mine, but not leveraging it effectively.
And the irony. The success of the investment portfolio seems to have made the board complacent about the map business.
That makes sense.
They had investment income rolling in, no real financial pressure. Stockholders still got dividends, even though they'd been cut 5 times in 8 years. And Buffett notes he couldn't find any record of suggestions to, cut executive pay or director fees. Raises questions, doesn't it? Whose interests were really being served?
Yeah, potential misalignment. Board's comfortable, maybe not motivated to do the hard work of fixing the core business.
And the board itself, heavily weighted towards insurance execs, 9 out of 14.
Go.
And guess how much stock they owned collectively? Out of 105,000 shares, they owned 46.
46 shares, total.
Total. The company lawyer, a banker, 10 shares each. Even the top Sanborn officers only own about 300 shares combined.
That lack of skin in the game.
Yeah.
Yeah, that suggests a disconnect between their interests and the shareholders.
Definitely. So the catalyst for change. The son of the recently deceased president wasn't happy with things, tried to get more involved, got pushed back, resigned.
Okay.
Shortly after, Buffett's partnership bought his mother's large block of stock. They also linked up with 2 other big, frustrated shareholders who really wanted to separate the investments from the map business. That was the moment.
The beginning of the activist phase, essentially. Yeah. Buffett stepping in to unlock that value.
Yep. They bought more shares in the open market, got their group up to about 46,000 shares. The plan was clear: separate the 2 parts, get fair value for the investments, and then try to revive the map business using electronic data processing. Modernize it.
Using technology, right.
Yeah.
Seeing the value in the data itself and how it could be used differently.
But predictably, they hit resistance from the board, especially the outside directors.
Even though Sanborn's own managers agreed, and consultants recommended it.
Yeah, board dug in its heels. So rather than a long, messy proxy fight, Buffett's group changed tactics. They offered to buy out any shareholder who wanted out at a fair value based on the assets. The SEC eventually gave it the green light.
Smart move. It's flexible, finding a practical way around the roadblock without a huge fight.
And it worked. About 72% of Sanborn stock ended up being exchanged for portfolio securities at fair value.
Okay, so most took the exit.
Yeah. The remaining map business was left with over $1.25 million in government bonds as a cushion. And crucially, they avoided a potential capital gains tax hit of over $1 million.
Nice.
And the shareholders who stayed, they saw the asset value behind their shares go up, earnings per share jumped, dividends increased. Seemed like a win-win-win almost.
Definitely sounds like it. A clear win for unlocking hidden value.
Huh.
Shareholders got liquidity if they wanted it, and those who stayed had a cleaner, financially stronger company.
Buffett uses this to stress, again, the need for secrecy sometimes in their operations and why you can't judge performance short term, especially with these control situations, which don't happen all the time. He circles back to the core strategy: buy undervalued securities, invest in special situations tied to corporate actions. And he hints, as the partnerships get bigger, maybe more control situations become possible.
Reinforces that patient, sometimes contrarian approach. Thinking long-term, being willing to act decisively.
Okay, shifting gears now to the mid-year letter. This one's from July 1961. And right off the bat, he says he's starting these semi-annual updates because partners asked for them.
Good sign. Shows he's listening to his investors, keeping them in the loop.
Yeah, definitely focused on that relationship. So first half of 1961 performance, he says all the partnerships did moderately better than the Dow. Dow was up about 13% with dividends.
Okay, so still outperforming, but maybe not by as much as in 1960.
Exactly. He notes it was a tougher market for them to beat compared to the down market of 1960.
Which fits his earlier point, right? In a strong rising market, his value approach might not keep pace with the really hot stocks.
Precisely. And he hammers home that point again. Don't rely on short-term results. 6 months even can be misleading. His focus, 5 years, across different market types, that consistency of message is so Buffett.
Absolutely. He's constantly managing expectations, trying to get partners to focus on the long haul, not just the latest quarter.
He then says, look, if this rapid market growth continues, he actually doubts they'll keep beating the DJIA. Might even fall behind.
Wow. Managing expectations downwards almost.
Yeah. He explains their portfolio, which he always saw as conservative, gets even more conservative as the market goes up. A bigger chunk gets put into things that are kind of insulated from the market swings.
Makes sense. Disciplined risk management.
Yeah.
As things get more expensive, he gets more cautious, builds a buffer.
He also teases something new, a potentially major commitment they'd been buying in the open market.
Oh.
Yeah. He says it might actually hurt short-term performance a bit,
Okay.
but he feels strongly it has great long-term potential and good defensive qualities. But he doesn't say what it is.
Keeping his cards close to his chest. Probably didn't want to tip off the market while he was still buying.
Must have driven the partners crazy, wondering. Anyway, he also updates on the partnership merger. Talks were ongoing with current and potential new partners. And he lays out the key points of the new combined partnership agreement.
Right. The move to streamline everything into one entity.
Yeah, a big step. Merger based on market value at year-end. Clear plan for handling future tax liabilities from unrealized gains.
Important details.
The new profit split. Partners get 6% on their capital first, anything above that. Split 75% to the limited partners, 25% to Buffett as general partner.
The classic Buffett structure taking shape.
And if they don't make the 6% in a year, that shortfall carries forward. He makes it clear this new deal is better for limited partners than most of the old ones, especially for returns up to 18% a year. Seems like he's incentivizing good performance, but also giving investors that baseline.
Yeah, aligning interests. He wins when they win big, but they get a base return first.
What about losses? No clawbacks against his past earnings, but losses do carry forward against his future share of profits.
Okay, so he doesn't have to give money back, but losses reduce his future earnings potential.
Right. And he stresses his own big personal stake, about 1/6 of the total capital. Plus, he promises not to buy any marketable securities outside the partnership. His money is right there alongside theirs.
That's huge. Real skin in the game, total alignment, powerful signal.
Totally. Few other practical things in the new agreement. Option for partners to take monthly payments, like an annuity, at 6% annually. Option to reinvest that, too.
Added flexibility.
Also, partners could borrow up to 20% of their interest at 6% for, unexpected short-term needs. Had to be paid back by year-end, though. He's clear, we're not a bank.
Sensible boundary.
And any small tax adjustments under $1,000, Buffett would just cover himself to keep things simple. Seems like he thought about the details, both performance and practicalities.
Yeah, offering convenience and flexibility while keeping the operation smooth.
He wraps up mentioning they'd asked for a tax-free ruling on the merger, expected things to be much simpler going forward. Tells partners, hey, save this letter for reference.
Good advice.
Minimum for new partners, $25,000. Not for existing ones, though. And year-end additions withdrawals could be in $100 increments. Total assets now estimated around $4 million.
Getting bigger?
Which allows for those larger investments, like that secret one he mentioned. Then he just invites questions on the letter or the new agreement. Very thorough, very transparent.
That communication style, that detail and willingness to answer questions,
Yeah.
that must have been key to building trust.
No doubt. So, okay, let's try to rack this up. This deep dive into the 1960 and mid-1961 letters. What have we really seen?
Well, we've seen that laser focus on long-term outperformance versus the market. A really deep grasp of market cycles and how crucial it is to protect capital when things go bad.
And that Sanborn Map story, what a case study in value investing in action. Plus, we saw the early steps towards building that bigger, more streamlined partnership.
Yeah, and what really strikes me is how relevant it all still feels, over 60 years later.
Yeah.
That focus on the long view, on understanding what something's really worth, it's timeless investing wisdom.
Absolutely. Which brings us to our final thought for you, the listener. Think about these core ideas value long-term perspective, market cycles laid out way back then in a totally different world. How could those principles maybe inform your thinking about building wealth, about navigating today's markets?
It's a great question. And honestly, reading more of Buffett's letters, especially the early ones, is like getting a masterclass. Highly recommend it. If you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.